Welcome to BWC News. I am Elizabeth. JPMorgan Chase recently announced the completion of its acquisition of First Republic Bank of America, a failed enterprise that was once the 14th largest bank in the United States, for $10.6 billion. This is the third regional bank to be taken over by the FDIC so far this year, following Silicon Valley Bank and Signature Bank. JPMorgan Chase said the deal will bring it about $2.6 billion in after-tax earnings, but it will also bear about $2 billion in restructuring costs. First Republic's branches are open for normal business on the first, and customers will continue to have access to uninterrupted services including digital and mobile banking capabilities. According to JPMorgan Chase's announcement on Monday, the bank's acquired First Republic assets include about $173 billion in loans and about $30 billion in bonds, while acquiring about $92 billion in deposits, including $30 billion in deposits provided by several large banks in the recent past. JPMorgan Chase did not acquire First Republic Bank's corporate debt and preferred stock. Behind this seemingly favorable acquisition, a deep crisis in the U.S. financial system was revealed. The bankruptcy and collapse of First Republic Bank has reignited the fires of the U.S. banking crisis. 2 weeks ago, according to Stanford University economists and many other analyses, 186 banks across the United States will go bankrupt and become the next Silicon Valley banks. The collapse of First Republic Bank also let the U.S. Treasury Department and the Federal Reserve were hit in the face one after another, because U.S. Treasury Secretary Janet Yellen and Federal Reserve Chairman Jerome Powell expressed more than once since March, after releasing emergency liquidity to the U.S. banking sector, the U.S. banking crisis will not spread significantly again. First Republic Bank lost more than $100 billion in deposits in the first quarter, data show. The bank's market capitalization bottomed out at nearly $557 million last week, down nearly 99% from its November 2021 peak of more than $40 billion. To make matters worse, U.S. commercial bank deposits plunged $174 billion as of April 19, reaching their lowest level since April 2021. Clearly, global investors have less confidence in the U.S. Treasury and the Federal Reserve's promise that the U.S. banking crisis will no longer spread, and have lost faith and trust in the entire economic system of U.S. banks, finance, the U.S. dollar, and U.S. Treasuries. People have lost confidence in the U.S. Treasury and the Federal Reserve and a series of monetary policy initiatives, including interest rate hikes and tapering. They have withdrawn cash from U.S. banks to prevent the possibility of assets or face discounting due to potential bankruptcy risks. With U.S. financial markets mired in inflation and recession fears, investors are trying to guess the Fed's next move, but they may be overlooking a more dangerous outcome: stagflation. A slowing economy overlaid with persistent inflation could extinguish the Fed's hopes of reversing tightening and cause many assets to be mispriced, reversing the rally in stocks, credit markets, and other risk assets so far this year. This is what some economists call mild stagflation, a troubling macroeconomic environment for investment managers who have not yet fully emerged from the shadow of the 2022 stock and bond double dip. There are few historical examples of economies in stagflation that can serve as a model for investing. For many fund managers, the preference is to trade high-quality bonds, gold, and stocks of companies that can maintain pricing power and that can withstand a slowdown. Research suggests that the risk of stagflation is rising and is mild. The Biden administration's preliminary estimate of first-quarter GDP growth supports this view. Data released April 27 by the U.S. Bureau of Economic Analysis showed that GDP grew at a 1.1% annualized rate from January to March, below the median estimate of economists surveyed and below the 2.6% growth rate in the previous quarter. Meanwhile, the core CPI index, which excludes food and energy, rose by 4.9% in the first quarter. The inevitable inflationary pressures, despite the recent credit crunch due to banking sector pressures, mean that Fed policymakers will likely raise interest rates again on May 3. The benchmark forecast in economic research is for the Fed to leave rates unchanged for some time after this week's hike, but economists warn that the Fed may need to take more action. As of May 1, international rating agency Moody's has downgraded more than 10 U.S. regional banks, including U.S. Hopewell Bank and Bank of Hawaii. Moody's believes that a growing number of U.S. banks have balance sheets under pressure, and even the safety and stability of some banks' deposits are in doubt. the Federal Reserve's continued rate hikes are one of the culprits. Gerard, Associate Director of Washington College of Law, said that as the Fed continues to raise interest rates, those uninsured deposits will still be lost in large numbers. This could lead to bank failures like a contagious disease and trigger a run. Particularly those banks that continue to falter are more likely to fail due to the amount of uninsured deposits they have. This suggests that the entire U.S. banking system appears to be in a continuing game of big fish eating small fish. Ultimately, the Federal Reserve, as a conglomerate of multiple U.S. banks, is effectively harvesting the financial spreads in the U.S. market on an ongoing basis. As with every financial crisis in U.S. history, in effect the Fed or U.S. financial giants end up cannibalizing the weaker banks or financial institutions. On a global scale, once the Fed or the U.S. Treasury, as the financial regulator, declares a U.S. bank's Credit Suisse-like additional Tier 1 capital bonds zeroed out, it is tantamount to putting the opportunity in the hands of the top U.S. bankers who can harvest the spreads of global investors. It is based on these signs of a breach of trust that analysts believe a default could occur in June amid this U.S. banking crisis, and with the added impasse over the U.S. $31.4 trillion debt ceiling, it is expected that up to $31 trillion could be withdrawn from the U.S. banking and financial system and flow into Asian markets, where the creditworthiness and prospects are much better. The U.S. today has been heavily exploited by these top banks and U.S. economists. This explains why many central banks around the world, including several traditional allies, have been liquidating U.S. treasuries for months at an accelerated pace. For example, according to the latest edition of the U.S. Treasury's International Capital Flows Report, at least 22 countries around the world simultaneously sold U.S. treasuries in February of this year alone. In particular, Japan, the United Kingdom, Canada, France, Germany, Italy, Australia and Israel, 8 traditional allies of the United States, collectively sold U.S. treasuries. U.S. financial analysts Zero Hedge said that Japan, Israel and other U.S. allies are accelerating the historic collapse of U.S. treasuries. Even Japan, Israel and other countries have the possibility of emptying U.S. treasuries, perhaps staging a sneak attack on U.S. treasuries in the financial Pearl Harbor. At the same time, the global accelerated de-dollarization, only in 2022 the share of the dollar in global reserves to the average rate of the past 20 years 10 times the decline. 2001, the dollar in the global reserves share of 73%, 2021 is 55%, and in 2022 only 47%. According to incomplete statistics, digital currencies are a de-dollarization phenomenon. Since 2020, the number of countries considering issuing their own digital currencies has tripled to more than 110 countries. These countries, which account for about 71% share of global GDP, are issuing or planning to issue sovereign digital currencies in order to achieve the circumvention of the US dollar for international trade and thus de-dollarization.